Hey guys, what's up? I'm Erin and welcome back to Erin Talks Money. So glad to have you. Investing. Investing isn't just for the wealthy. Of course, you can catch them lounging around the country club talking about their latest investment, but there's a big misconception. You do not have to be wealthy to start investing. Yes, there are investment accounts that do have minimum balance requirements, but not all do. So whether you have $5 or even a couple $1,000s, I want to show you how you can get started investing today. You do not need to be a Rockefeller to get started, but you do have to have the motivation to do so. Because remember, when it comes to investing, time is your best friend. Time is what allows your money to compound and grow and generate wealth so you can one day retire, and you can never get time back. So make sure that you start as soon as possible, preferably today. Now I'm going to go over my favorite investment choices, whether or not you have $10, a couple $100, $1,000, or even all the way up to $3,000. But before we get started, I just ask that you quickly take a moment to hit that like button below. That costs nothing at all. So if you have just a couple dollars all the way up to say $900, the company I recommend is Charles Schwab. And the reason I do so is because they have $0 minimum requirements on their index funds, which allows absolutely anyone to get started. Now, theoretically, you could get started with just some pocket change. And I say theoretically because that's not the most ideal way to start. You certainly could, because there are $0 requirements in these accounts. But I would like to see you at least buy one share of an index fund. Currently, the S&P 500 index fund with Charles Schwab is trading around $43. So if you could have at least $43 to get it started, I'd like to see you have a full share. But keep in mind, with index funds, you do not need to buy whole shares at a time. They do allow you to buy partial shares. So you don't need to have the whole $43. You can start with any amount you want. So if your goal is simply just to get started, Charles Schwab is the company for you. I'm going to list the ticker symbols for their index funds right here. All you have to do is type those into Google. It'll bring you to the Charles Schwab page if you're interested in getting one of those funds, and you can get started. Now, the great news is that Charles Schwab has been around for a very long time. It is a highly reputable company, and they are great to long-term investors. These are very tax-efficient accounts, and they have very low expenses. So you're not paying a lot of fees. Their expense ratio comes in at 0.03%, which is fantastic for the industry. So just get started with any dollar amount you so choose, and then after that, make sure to keep adding to your fund so you work on building your wealth as quickly as possible. Now, if you have $1,000 burning a hole in your pocket ready to be invested, I recommend the Vanguard Target Retirement Fund, because just for $1,000, you get a fully diversified and balanced portfolio that will evolve with you as you age. Now, they could not have made this process any more simple. All you have to do is go to the Vanguard Target Retirement Fund page. Simply to find it, you can go to Google and you can type in Vanguard Target Retirement. It's the first one that pops up. You scroll down, look for the fund that best aligns with your birth year, because they base our probable retirement age on the year in which we were born, because we all have similar working years. And you will be directed directly to a fund that will mature with you as you age. Now, all of these funds are composed of the same 4 index funds. They have US Stock Index Fund, the International Stock Index Fund, US Bond Index Fund, and the International Bond Index Fund. Now, the differences between these funds is that the longer your time horizon for retirement, the more aggressive these funds are going to be. So the more heavily weighted they are going to be towards stocks and away from bonds. The closer you get towards retirement, the more heavily they're going to be weighted towards bonds as opposed to stocks. Now let's throw 2 up on the screen just to compare the 2. So say you pick the Retire in 2060 fund, which is about 40 years away. You'll notice that this one is about 90% stocks and only 10% bonds. However, we compare that to the Retire 2030 fund, which is only 10 years away. That one has a little less than 70% invested in stocks and a little more than 30% invested as bonds. So you can see that the fund is getting more conservative as you get closer and closer towards your retirement. So the way these funds work is that every handful of years, the fund will automatically adjust itself to being slightly more conservative, aka taking a little more out of stocks and putting a little more into bonds. So when you're ready to retire, you have a far more conservative fund than when you started out. These are the ultimate set it and forget it funds. If you want a hands-off approach, you don't want to have to do work with your investments, choose a target retirement fund. These funds make it simple. You do not have to deal with any sort of balancing or rebalancing of your portfolio. It's all taken care of for you. Now, once you have that initial investment of $1,000, you can add to your fund at any increment or any interval you so choose. You want to do 10 bucks a week? Sure. You want to do 500 bucks a month? Go for it. You just have to have that initial investment to open the account, and then you're good to go. Now up to $3,000. With $3,000, that is the minimum balance requirement for the Vanguard Total Stock Market Index Fund Admiral shares. Now, any true indexer is going to have a special place in their heart for Vanguard, because after all, Vanguard was founded by the one and only Jack Bogle. He is the inventor of the index fund. So to me, the Vanguard Total Stock Market Fund is truly the gold standard. Now, you have to bear in mind that the Vanguard Total Stock Market Index Fund is 100% stocks, so it is not a balanced portfolio like the Target Retirement Fund. So if you're looking for straight stock exposure, this is your fund. It is composed of actually 3,521 different stocks. So yes, it's going to have some volatility. It does go after the more risk, more reward category because it is 100% stocks, but it is a great addition to any portfolio if you're putting together your own. And it does have rock bottom expense fees. It has a really great track record for performance. So it's a really good fund to add into your portfolio. And again, like the Vanguard Target Retirement Fund, once you have your initial investment, that $3,000, you can add any amount you want at any interval you want. If you want to do 25 bucks a week, yep, you can do that. If you want to do a monthly edition, you can do that too. So it's just getting that initial $3,000 to get the fund started, and then you're all set and good to go. Now, you could get the same exact exposure to the same exact stocks in the same exact percentages for a far lower price than $3,000 by buying the Vanguard Total Stock Market ETF Exchange Traded Fund, which is currently selling for around $140. So with $140, you could get that same exposure. But I still recommend you wait and save up your $3,000. Here's why. ETFs and index funds are not the same thing. They're similar, but they're not the same. Anytime you add to your ETF, you are charged a $7 transaction fee. When you add to an index fund, you are charged a $0 transaction fee, and $0 beats $7 any day of the week. Also, when it comes to ETFs, you can't buy fractional shares. So if you want to buy one share, you have to put in $140. You want to buy two shares, $280, and so forth. However, once you have started your index fund, you can add $25, you can add $50, you can add $100, you can add any amount you want because you can buy fractional shares of index funds. Index funds are far more convenient and cheaper in the long run, so stick with the index fund. Save up that $3,000 if this is really a fund you want, and just nix the ETF. So I hope you learned that you truly can get started investing no matter how much money you have. Start early, invest often, and allow your money to have the time it needs to grow. If you want to play an active part in your investment portfolio, I recommend choosing individual index funds. It will require that you rebalance your portfolio periodically every year or so. However, if you're after the more set it and forget it hands-off approach and you don't want to do any rebalancing, I recommend going for a target retirement fund. They are all great choices. Choose what is best for you you just get started investing, allow your money the time it needs to grow, and make sure that you hit that like button on the way out. That's just as important. So subscribe, share. I love having you guys here. I hope you have a great day. Stay tuned for many videos to come. I post every Monday and Friday. I'll see you soon. Bye.